Welcome back to Investing Talk Podcast.
Good to be here.
Today, we're zooming in on Compass, ticker COMP. You flagged some really interesting information about them.
That's right. Quite a bit to sift through.
Yeah, our goal is basically to unpack what's most crucial for listeners right now. We've got news bits, a detailed rundown, an overall analysis, quite a collection.
So let's try and make sense of it together.
Okay, first thing, that acquisition of Legacy Texas Title Co. stood out. What does a move like that typically, indicate for a company like Compass?
Well, acquiring a title company like Legacy Texas really signals Compass wants more control end-to-end over the real estate transaction.
Like vertical integration.
Kind of, yeah. By bringing title and escrow in-house, they get direct access to data, maybe streamline things, potentially offer tailored services. It wasn't really possible relying on outsiders for that.
So it suggests a strategy to be more than just a brokerage.
I think so. A more comprehensive service provider, really controlling the whole experience.
That makes sense. Okay, shifting gears a bit. The stock price. COMP saw a dip, 6.90% as of April 9th, 2025, closing at 7.275 centers. What might be driving that kind of movement? Thinking about the wider market and, the real estate sector specifically.
Well, there are always various forces at play, aren't there? General investor sentiment can hit stocks across the board.
Sure.
And within real estate, you've got interest rate chatter, housing trends, what competitors are doing. All that can influence a stock like COMP.
So without specific bad news from Compass itself.
Right. It's plausible the market's reacting to broader economic signals, or maybe just some sector-specific adjustments happening. Hard to pinpoint sometimes without a clear catalyst.
Interesting point. And the industry itself is changing fast with tech, isn't it?
Absolutely.
Compass positions itself right there, integrating tech with traditional services. But competitors like AXP and the agency are growing too. How vital is this tech strategy for Compass's edge?
Oh, I think it's crucial. Technology is becoming, well, indispensable in real estate now.
So they're all digital platform.
That platform gives agents tools for productivity, marketing, client management. It's meant to be a real draw.
And a differentiator.
Potentially a significant one, yeah. It attracts agents who want those tools, and it can offer clients a more, let's say, modern experience compared to older models. It's about efficiency and service level.
Okay, let's dig into the financials then. Compass reported pretty strong revenue growth, 25.9% year over year in Q4 2024. It's $1.38 billion.
Impressive numbers.
And they're forecasting over 25% growth again for Q1 2025. What does this kind of rapid growth tell us about their market strategy and maybe their potential?
Well, that kind of growth definitely suggests their approach is working. It's likely a mix, more transactions, maybe higher home prices playing a part. It shows they're capturing more market share.
We also saw that organic revenue grew 20.9% year over year in Q4. Can you clarify the difference, overall versus organic growth?
Good question. Organic growth is key. That's revenue from their core business, basically commissions from their existing agent network selling homes. Overall growth includes that, plus any revenue from acquisitions like, say, Legacy Texas Title or Christie's Real Estate. So the fact that their organic growth is also strong, over 20%, that's a really healthy sign. It means the fundamental business itself is expanding, not just growth through buying other companies.
That distinction is helpful, thanks. Now, sticking with financials, Q4 2024 earnings per share. It was negative $0.08.
Right. Still a loss per share.
But it actually beat the analyst consensus estimate. How should we read that? A negative EPS in a growth phase, but better than expected.
It's pretty common for companies like Compass in a heavy investment phase to show negative earnings. They're spending a lot on tech, marketing, expansion.
Right, investing for the future.
Exactly.
Wow.
So beating the consensus, even with the negative number, is actually positive. It suggests maybe their investments are paying off faster than expected, or perhaps they're managing costs better than analysts predicted.
So an encouraging sign on the path to profitability.
I'd say so, yes.
Fair.
It points in the right direction.
Okay, another key financial point. Compass anticipates positive free cash flow for the full year 2025.
No, that's a significant milestone.
Why is achieving positive free cash flow so important, especially after all this heavy investment?
Well, think about it. Positive free cash flow means the business is actually generating more cash than it's spending after all the operating costs and capital investments.
So money coming in, not just going out.
Precisely. It gives them financial flexibility. They can reinvest more, maybe pay down debt, pursue more acquisitions, eventually maybe even return capital to shareholders. Though that's likely a way off.
It sort of validates the business model, doesn't it?
It really does. Shows the potential for long-term sustainability.
Let's talk about what makes them stand out. Compass really emphasizes its proprietary all-digital platform for agents and also that strategic acquisition of Christie's real estate.
Two key pillars for them.
How much do these factors actually bolster their position in what's, let's face it, a pretty crowded market?
I think they're quite significant differentiators. The digital platform, as we discussed, can boost agent efficiency and attract talent. It could improve the client experience, too.
And Christie's.
Christie's gives them instant brand recognition in the luxury market, access to a whole different clientele, and a global network. Together, they broaden reach and strengthen the brand image significantly.
So their overall strategy seems to be about disrupting the traditional model using tech and these kinds of acquisitions.
That's the goal, yes.
How sustainable do you think that strategy is, given the established players and the potential for new disruptors to pop up?
That's a really important question. Their tech and acquisitions give them a strong base, no doubt. But the real estate market is always shifting.
Established players aren't standing still either, right?
Exactly. They're also investing in tech, and new startups could always emerge with different models. So Compass's long-term success really hinges on continuous innovation, integrating those acquisitions smoothly, and maintaining an edge in both tech and service. It's an ongoing battle.
We have another stock price point here. As of March 21st, 2025, COMP was at $9.39.
Higher than the April figure we mentioned.
Right. And the analysis connected to that price suggested resilience, positive momentum from tech investments, the Christie's deal. How does that March price align with the later dip in April?
Well, it really highlights how volatile stocks can be, doesn't it?
Yeah.
The $9.39 in late March likely reflected optimism around those strategic moves you mentioned.
Market feeling good about things.
Perhaps. Then the drop to 7.275 cents by early April could have broader market shifts, sector corrections, maybe some profit taking after the run-up. It just underscores you need to look at trends, not just single snapshots.
Good reminder. Okay, market share. Compass saw its share increase by about 65 basis points year over year in Q4 2024, reaching about 5.06% overall.
A noticeable gain.
What does that gain tell us about their ability to actually win business? The basis point is tiny, 100%, so 65 is 0.65%.
Right. And gaining over 0.5% of market share in this industry in a year is significant. It clearly suggests they are successfully attracting agents and clients.
Taking business from competitors.
It implies that, yes, it shows their value proposition is resonating and they can execute. It's a positive signal for future growth.
Another point was operational efficiency. Their gross profits improved because they managed commission expenses well, keeping them around 83% of revenue.
That's an important metric.
Why is that specific metric, commission expense as a percent of revenue, so critical for a brokerage? And what does keeping it consistent suggest?
For a brokerage, commissions are usually the single biggest cost. So keeping that percentage stable, especially while revenue is growing rapidly, shows good control over that key expense.
Means they're scaling efficiently.
It suggests that, yes, points to efficiency in the model and predictability in their costs, which is really crucial for eventually hitting consistent profitability as they get bigger.
Okay, let's look at the balance sheet. Total assets around $1.2 billion. The debt-to-equity ratio was noted as somewhat elevated.
Which isn't uncommon for growth companies.
But balanced, the analysis said, by solid asset turnover. What does this mix tell us about how they're managing their finances and growth?
It paints a picture of a company using debt to fuel expansion, like you said, common in growth phases. The elevated debt to equity means more financial risk they owe quite a bit relative to shareholder equity.
But the asset turnover.
That being solid is good. It measures how well they use assets to generate revenue. So it suggests they're deploying resources effectively, even the ones funded by debt. It's a trade-off.
Leverage for growth versus asset efficiency.
Exactly. The debt makes them more vulnerable to interest rate hikes or market slowdowns, though. It's definitely something to watch. Are they planning to bring that debt ratio down over time? That would be ideal.
And looking ahead, operating expense guidance for fiscal year 25, forecast between $1 billion and $1.03 billion.
Still significant spending.
Right. Even though they expect positive free cash flow, that's a lot of expense. What's likely driving those costs? And what does it mean for future profits?
A big chunk is undoubtedly the technology platform R&D, maintenance, upgrades, plus sales and marketing to attract agents and clients. That's always costly.
Needs fuel to keep growing.
It does. So while positive free cash flow is great, these large operating expenses mean they need continued strong revenue growth to achieve substantial, consistent profitability down the line. The investments have to keep yielding returns.
Okay, let's summarize strengths. We've touched on strong revenue growth, expanding market share, the proprietary tech, strategic acquisitions like Christie's, and that outlook for positive free cash flow.
Solid list.
Of those, which do you find most compelling for their long-term prospects?
If I had to pick, I'd say the combination of the proprietary technology and the expanding market share.
Why those two?
Because the tech offers a scalable advantage, something they can build on. And the market share gains show it's actually resonating with agents and clients and translating into real growth. The other factors support this, but those feel core.
And on the flip side, the red flags mentioned were those elevated operating expenses and the slightly high debt.
The balancing factors.
How significant are these concerns, really, for a company that's explicitly focused on growth right now?
It's all about balance, isn't it? High operating expenses are expected during growth, but they can't outpace revenue growth indefinitely. That's unsustainable.
And the debt.
Adds risk. Makes them more sensitive to economic bumps or rising interest rates. They're not necessarily deal breakers for a growth story, but they are factors investors absolutely need to monitor. Is the growth being managed responsibly? That's the question.
It's always worth considering market sentiment, too. Investors and analysts seem cautiously optimistic, focusing on the tech, the Christie's potential.
That seems to be the general feel, yes.
Social media discussions apparently echo this, but also mention the competitive pressures. How much weight should we give these broader sentiment indicators?
Sentiment provides context, but you have to be careful. Analyst opinions are based on research, models, hopefully solid stuff. Investor sentiment reflects market mood, confidence.
And social media.
Can offer real-time vibes, but is often noisy, driven by short-term stuff, maybe not always verified. So, useful as a backdrop, yes, but always weigh it against the fundamental analysis, the financials, the strategy.
Makes sense. Thinking about competitors again, Compass's tech integration is seen as a key difference from traditional brokers, maybe even an edge over others with less integrated tech.
That's their bet, certainly.
How might that difference actually play out in the day-to-day for agents and clients? What does it feel like?
Well, for agents, an integrated platform could mean less juggling different apps, maybe automated marketing help, better data insights, freeing up time to actually talk to clients.
So more efficient agents.
Potentially, yes. And for clients, it could translate to a smoother, more transparent transaction, maybe better communication, easier access to documents and updates online. It's about enhancing the experience for both sides.
Like a well-oiled machine making things easier.
That's the idea. That improved experience could drive loyalty and referrals.
Okay, looking to the future. Potential catalysts mentioned, continued integration of Christie's, and the upcoming Q1 fiscal 25 earnings, where they project that 25% plus revenue growth.
Key things to watch.
What specifically should we look for in those developments to confirm the positive outlook?
With Christie's, look for evidence it's actually working cross-selling, revenue synergies being realized. Are they selling more high-end homes?
And the Q1 earnings?
Beating that 25% growth forecast would be a strong signal. Also, listen for updates on managing those operating expenses, progress towards sustained profitability, and positive free cash flow. Any commentary on continued market share gains or agent productivity metrics would be important too.
And what about future risks? Regulatory changes in real estate and macroeconomic factors hitting housing demand seem like the big uncertainties.
Always lurking in this sector.
How could those external factors specifically impact Compass's model?
Oh, significantly. Regulatory changes, especially around commissions or how deals are done, could directly hit their revenue and force operational changes.
Like the NAR settlement implications.
That's a prime example of the kind of regulatory shift that could have wide-ranging effects. And macro factors, rising interest rates, and economic downturn, those directly impact housing demand. Fewer sales, maybe lower prices. That hits their commission revenue hard.
So adaptability is key.
Crucial for navigating those external headwinds.
All right, bringing it all together, the overall recommendation we're seeing is a kind of hold moderate buy.
A balanced view.
What factors do you think lead to that nuanced stance? Balancing the clear positives with those potential risks we've discussed.
I think it reflects exactly that balance. You've got strong growth, tech leadership, market share gains, the path to positive cash flow, compelling stuff.
Right.
But you also have a high operating costs, the debt level adding risk, and the ever-present uncertainties in the housing market and regulatory environment. So it suggests cautious optimism, good potential, but enough risks to warrant not going all in, perhaps.
So stepping back from the details, you've given us a really thorough look at Compass.
Tried to cover the key angles.
We've seen a company growing fast, leaning heavily on technology, making strategic plays like the legacy Texas title acquisition and Christie's,
Definitely dynamic.
strong revenue, growing market share. That anticipated positive free cash flow, all notable positives.
For sure.
But we've also hit on the stock fluctuations, those significant operating expenses, the debt,
Yeah.
and the external economic and regulatory factors that need attention.
Important context.
Hopefully this overview has helped listeners distill the key insights from all this information. It certainly brings up some interesting questions about where Compass goes next, how they navigate this evolving landscape.
It'll be interesting to watch.
We definitely encourage listeners to check out their investor relations materials for more detail and keep an eye on those upcoming catalysts like the Q1 earnings.
Always good to do your own homework.
And if you found this exploration helpful, please do subscribe, like, and maybe leave us a comment.